it's really a core part of our mission that we're a financing bank and we're an intermediary to help corporates, sovereigns, as you say, raise capital in the capital markets. And we feel ourselves to be extremely well positioned for that, as we demonstrated last year, of course, and while the capital markets were open to deal with the impact of the pandemic. Of course, in this quarter, investment grade sort of, again, normalized against the very high levels of issuance in the second quarter of last year. But while we saw that decline, we saw a normalization, if you like, in the other direction of leveraged debt capital markets. And so we've participated, I think, well in the activity this quarter.
Talking about the asset management side of things, it seems that asset management wants to grow as well, non-organically, right? So where do we stand here?
Nothing we can say. I think we've been consistent in the language that we think DWS has now put itself in a position to pursue acquisitions if they can find the right partner and the right transaction. It was always part of the rationale for creating a separately listed company, was to enable them to grow. And the really great thing about the story there is, in the years since the listing, they've really done everything that they set out to do in terms of managing and improving their own standalone business. And I think it positions them well to participate in consolidation in their industry.
The only weak spot, it seems, in the numbers is the corporate bank, with revenues down by 8%. So what happened there, and what's the outlook? Is that a normalization which we're seeing now?
So we talk about episodic expenses in the corporate bank, and they happen essentially every quarter, but it can change and vary within a range. This quarter happens to be a very tough comp for the corporate bank. So they had about 90 million less in episodic revenues this quarter against a very strong quarter last year. They also had an impact from FX. And so if you wash out those two items, they're essentially flat year on year. And to our mind, that's really strong performance, because they're also fighting through 80 million still in this quarter of an interest rate headwind. In those markets that they serve, where interest rates had not yet adjusted to the crisis environment, we still had a higher revenue capture. And so that now is all but washed out of their numbers. To your question then, we do see growth ahead, certainly in the second half, and we see ourselves as being on track for the step-off into next year that we were expecting for them to hit their targets.